For further analysis, we're joined from Chicago by the director of the Quorum Center for Strategic Studies, Tariq Al-Rifai. Welcome, sir, to the Economic Bulletin. Firstly, sir, let's start off by asking, why did the Fed Reserve decide to keep the federal funds rate target range steady at 4.25% to 4.5%, despite the signs of some economic slowdown?
You're correct. There were some signs of economic slowdown, but overall, the economy is growing at a healthy pace. Unemployment rate has not increased significantly, and if you look at where the unemployment rate is increasing right now, it's mainly due to federal government-related jobs, whereas manufacturing, it began or it ended last year slowing down. However, manufacturing sector has picked up, as well as the services sector has also picked up. So there are some positive signs which outweigh some of the negative signs, and this is why the Fed's decision to maintain the current interest rate policy.
So basically, the Fed's wait and see approach reflects this idea or this assessment of the current economic conditions, even despite the uncertainties there.
There are uncertainties, but if you look at inflation, yes, he mentioned it is slightly higher than their 2%. It's right now around 2.4%. Unemployment rate is at 4.2. They're projecting that it goes to 4.4. So, slight increases, but overall not enough to justify changing the monetary policy at this time.
Okay, so what factors have contributed to the Fed's downward revision of the U.S. economic growth forecast from 1.4% to 1.4% for 2025 and 2026?
Well, it goes without saying that the trade war and the tariffs, obviously, that has dramatically increased the chances of an economic slowdown, as well as with increase in costs. And if this prolongs, it could also see inflation tick higher as well. Those are both scenarios that the Federal Reserve, of course, would like to avoid. So with that in mind, those are some scenarios that would indicate higher risk and potentially, change in Fed policy. However, if you look at the other factors that are taking play as well, interest rates remain relatively high if you compare it to the past, several years. Housing market is slightly slowing down. So these are all factors that the Fed must weigh in and balance.
So, in what ways has the Federal Reserve's interest rate decision in 2025 contradicted Donald Trump's public calls for aggressive rate cuts?
Obviously, the president, should not and does not influence interest rate because the Federal Reserve and the central bank, in essence, is an independent entity, and they set policy based on their economic targets and objectives for the economy. So, calling for lower interest rates does not mean necessarily that the Fed will be pressured into lowering interest rates, and it doesn't go into in line with market conditions to lower interest rates. That would obviously create more risk appetite and could potentially create bubbles in the future with having low interest rates and a fast-growing economy. That, of course, spells trouble ahead.
Okay, now the Fed chair had highlighted that the unemployment rate has dropped. How does this latest sign affect the credibility of Trump's claims that the Fed is holding back the decisions, or rather suggesting that holding back the economy?
Uh, Interest rates, as I mentioned, have remained fairly stable, and of course, the Fed has not changed interest rates recently. Growth in the economy, if you look at GDP growth in the US, it has slowed down. So this is what President Trump is saying. Well, GDP is or growth is slowing down. Economy needs to grow faster. In order to grow faster, and especially in the real estate sector, obviously this is one of President Trump's areas of expertise. He says we need lower interest rates. So those are the driving factors behind the push or the demand for interest rates to be lower. But of course, if you look at the Fed's overall objectives, the healthy state of the economy, there aren't enough negative signs yet to justify lowering rates.
Since you're discussing this topic here, how does Powell's recent remarks about a strong economy and the falling unemployment rate, as you've mentioned, challenge the narrative that the US is heading towards a recession, as sometimes suggested by Donald Trump?
Obviously, every economy goes through a cycle. So there's a growth period, there's a slowdown, and there's a recession. Are we due for another recession? The last one we had was in 2020 and 2021 with the COVID era, I would say, which was more global than just local to the U.S. However, if you look at Europe, Europe is slowing down. Some countries in the Eurozone are seeing negative growth or contraction in their economy. The U.S. as well has seen a slowdown. So yes, we could potentially be headed towards a recession. But can the Fed avoid it? I don't think the Fed can avoid it. They've never been able to avoid a recession in the past. It's just a cycle that the economy goes through. However, President Trump, during his term, he would like to see this avoided. And by avoiding it means trying to push growth further. And by pushing growth further, he needs to see lower interest rates.
Well, now the Fed is playing some sort of balancing act. How does the Fed plan to balance its dual mandate of both maximum employment and maintaining a 2% inflation given the revised projections?
Well, I mean, one factor that hasn't been widely used is the Fed really keeps an eye on the stock markets, the financial markets, how healthy are they? If we're seeing financial markets, fall drastically as we saw during the COVID era, this is before any sign of a recession. Of course, the Fed drastically reduced interest rates. So the Fed does keep an eye on the health of the stock market, which is I guess, a leading indicator of what lies ahead for the economy. So that is one indication. Of course, rising tensions now and geopolitical factors come into play. So what happens over the next few weeks and maybe a few months will determine what the Fed does at its next meeting.
What risks does the Fed identify that could cause further adjustments to interest rate policy in the future or in the near future?
The near future, obviously, with the tariffs, rising tariffs or continued rising tariffs, especially on major economies such as China, as well as rising geopolitical tensions. What markets are looking to now, they price in pretty much what's going to happen in the trade war and trade policy because it looks like the countries are looking and seeking to find ways to come to a conclusion. However, geopolitically, this is unknown as of now, and this is the risk that the markets are paying attention to.
Well, now that you've mentioned several times here the geopolitics of things and what's happening in the world obviously affects the economy. What immediate effects would a US war have on the federal government spending and the national debt, and how might this influence economic growth in general?
Well, the influence on national debt and economy, that will take, months, maybe even half year or more to kind of see the effects on the economy. However, immediately, and what we have seen is, the rising oil prices, and right now we've seen the price of oil rise at the fastest rate since, the Russia-Ukraine war began. So this is a sign that the current war and geopolitical tensions could have some longer lasting power on markets or effect on markets than what has seen because initially when we look at geopolitical tensions you see a spike in oil. 1 or 2 weeks later oil goes back down to where it was before the ten began. However, this time around we're seeing that this rise is sustainable and it's increasing. So markets are very nervous about this, and what this means is if the price of oil were to rise and continue to rise, it puts pressure on not only the U.S. but other economies as well. That inflation is going to be coming back and will be rising, which means the Federal Reserve as well as other central banks around the world, instead of lowering interest rates or keeping them steady, might be forced to raise interest rates to keep inflation at bay. And this, of course, will be negative for economic growth.
Well, as you said there, sir, that markets are sort of having the jitters because of what's happening. Now, President Trump came out with a statement yesterday when asked about intervention, U.S. intervention with the Iran-Israel thing, said may or may not intervene. How does this impact the economy, especially inflation, government spending, as well as the market stability in general?
Well, as we all know, I mean, statements made by President Trump, of course, a lot of them are met with uncertainty because, obviously that statement alone does not give you the assurance whether or not the U.S. will be participating or be playing a more active role. And uncertainty is what markets do not like. So as long as there's clarity in the markets, I think that's what everybody is looking for. And right now there is no clarity. So this, of course, creates even more tension as to what will happen. And of course, if the U.S. were to get more involved, this, of course, will be negative for markets and will be negative for global economic growth for the rest of the year because, like I said, you'll see rising price of oil, rising price of other commodities, and of course, it could be a return to inflation, and nobody wants to see a return of inflation.
What about disruptions in the supply chain in the Middle East due to the conflict? How can this affect the US manufacturing and consumer good prices in general, especially with threats to places like the Hormuz Strait?
Yeah, if you're talking about supply chain effects, of course, the Red Sea and the Suez Canal, I mean, this
Mm.
has more effect on, I would say, the overall broader economy, manufacturing, et cetera, especially trade between Asia and Europe. However, when we're talking about the Strait of Hormuz, this pretty much affects the price of oil and to some extent natural gas. So that would be the effect that we would see. We would be concerned more about the supply chain effects on oil and what it means to disruption of the oil supply more than any other sector.
Okay, that was the director of the Quorum Center for Strategic Studies, Tariq Al-Rifai. Thank you so much for your insights and thank you for joining us.